Hi, everyone. This is Will, aka Dr. Financial Literacy. I wanted to thank you, everyone, for stopping by today. This is March the 31st, 2024, and this comes to a conclusion of another experiment using biweekly paychecks to do velocity banking. Simple definition of velocity banking is simply using someone else's money or a company money to pay down debt. One of the things that I did in the biweekly experiment for this particular month was to take my biweekly paycheck from my employer and deposit it into account and make all the withdrawal from that particular account. So let me show you the deposits that were made. First of all, in that account, try to use some receipts to show my actual usage to you in general. So showing that I practice what I preach in general. All right, so let me go ahead and share the screen now. Sorry about that. Share my screen. Okay. Okay, so here are the deposits for my biweekly paycheck, and let's look at the total. So deposited 2,282 decimal 21 plus 10 plus 1,000 plus 9765, which gave me a total of $3,389.86. Those were the deposits from my biweekly paycheck. So it really doesn't matter as much if it's biweekly or weekly or monthly or commission. One of the most important things is probably trying to get your money in to the instrument or the debt that you're trying to pay down as soon as possible. So with me making those four deposits, I had the opportunity to break the average daily balance and hopefully save on some interest in general. Now, today I'm just going to talk about just still being happy with the velocity banking product. I wanted to look at one of my mortgages and what I started off with, where I am now, and how I will use velocity banking in going forward. So here we have one mortgage that I started with $46,000 in 2008. I started July of 2008. It was a 30-year mortgage. I'm having to make 360 payments, which contractually with a mortgage company, that was going to be about $110 over 30 years or 360 payments at 6.875%. Now, from the 110, I would take away the principal of $46,000, and I would basically be paying $64,000 in interest over the next 30 years on a $46,000 payment. So when some advocates speak of buying the bank house first and buying your house second, or front loading the interest, yes, that is the contract that I signed. I didn't sign the contract with buying them a house, but I signed a contract with making $110,000 in payments over 360 months, and then it was up to me to see how that would go. Would I take extra money that I have and make payments or other things with it. In doing that, when I first settled, there's two components that I did with this $46,000. There was a promissory note or the debt or the IOU between me and the bank that I simply signed saying that I will pay back $110,000 in general for the money that you're giving me. From $46,000, I'm gonna pay you back $110 and allow you to make $64,000 interest on me. Either I pay it back early, I pay it off early, I find a HELOC, a personal loan, or some other instrument to interrupt this $64,000 in interest. Now, I could have got this $46,000 in January and then paid it off in August, and I would not have been even concerned about this $64,000. I'm not concerned about the interest that is going to be paid because it was a contract that I signed. The second part of it is the mortgage is also part of the signed documents in 2000 that I signed. That was the actual lien or the collateral that was taken down to the clerk or to the recorders in my particular county to show that if I did not pay off this promise that I made, then they can come and obtain the property that they gave me. So again, if you decide to get a mortgage, there's going to be that promissory note that you sign, which is a document that may tell where you send your payments, how much of your payments, your interest rate. Then you're going to have this mortgage lien to show who is owning the home in case a default happens, the judgment that can occur, and other things of that nature. Now, because I promised to pay $110,000 over 360 months, I've made 176 payments thus far, or about 15.75 years. That means I paid $54,000 of this 110, not the principal 46, but just of this whole promise. I promised to pay 110, and so far I paid 54,000. That leaves me with fulfilling my promise of $56,000. Now I can do some things to reduce that promise in general, which could be velocity banking. I can get a home equity line of credit. I can get a personal line of credit. I can get a business line of credit, or I can just go to a relative or a stranger and they can lend me the money, and then I can pay this off early. So there's no prepayment penalty to this particular loan that I have some made. So right now I currently owe $28,000 that's shown as a principal. Now on the promissory note, in general, I'm still obligated now to $56,000 or another $184 in payments in principal and interest of $304.29. So after I make 304 principal and interest payments at 184, that'll give me 56,000. And this is the promise that I made to pay. Now, again, the promise is different from, okay, they will allow me to pay early, so I'm not fully obligated to this promise because they still will let me just pay off the principal, which as of 3/1/2004 is $28,000. So if I wake up tomorrow and I go ask a cousin or a relative or somebody that can I have $28,000, I can walk in and pay the bank outside of a couple of more days of interest $28,000 and we're done. We are finished. And I will save another $28,000 in payments in general. Now, as to velocity banking, I'm going to continue to utilize velocity banking because I try to get a home equity line of credit on one of my properties back in December. Wasn't successful. Came back and I've improved my credit. Velocity banking has been very beneficial in the sense that I'm now taking my paycheck, and as soon as I have the money to hit the banks, I take it over and place it on one of the credit cards that I'm trying to pay down. And through this new method of using velocity banking, I've been able to pay off, I think maybe 5 or 6 credit cards with about 10 to 20 some thousand dollars. Yeah, 10 to 20 some thousand dollars over the last 3 to 4 months. So without getting a home equity line of credit, I'm gonna continue velocity banking, pay down all my credit card debt first to try to build up the credit so that I can come back to the HELOC. Velocity banking, rather was doing it bi-weekly, half of a month. It has significantly helped me, not theoretically pay down my debt, but in the real world, pay down my debt. I'm going to continue to use velocity banking, continue to learn the principles. And I think or hopefully I can get a personal line of credit or a home equity line of credit that I will just blow out my debt. My overall debt has gone from 300 and about $50,000 to now I'm down to $310,000 using the principles of velocity banking. I think it's just going to get better from here, and I will incorporate more of the principles of velocity banking into my lifestyle, into teaching some of the clients that have come aboard, and I'm working with them to help them also understand velocity banking and just save some of the resources. Thank you again, Dr. Financial Literacy, aka Will. I am not a certified planner. I'm not an attorney. I'm not a CPA. I am a political economist, and I run financial experiments on myself first, and then use the findings to talk to my clients and help them reduce their debt. If you're interested in paying down your mortgage faster, paying down your credit card faster, please give me a call, and I'd love to work with you. Until then, thank you very much. Have a great day.